In this video, I'll be giving you a market update for how Toronto real estate performed in May, but before I get into the numbers, let's go over what recent events occurred that affect the real estate market and what to expect this June and into the summer months. Most of the graphs that I'm presenting to you today, I pulled off Twitter from the accounts of Daniel Foch, Steve Suretsky, Scott Ingram, and John Passalis. Other market stats I pulled directly off the MarketWatch reports provided by the Toronto Regional Real Estate Board. June tends to be somewhat of a transitionary time in Toronto real estate, summer being really only about 3 months here in Southern Ontario. Many buyers and movers tend to put their plans to move on pause to enjoy the summer and travel. While June is usually still active, we certainly start to see transactions slow down or level off as we head further into the summer. And how quickly this happens is really a testament to the number or amount of buyers in the buying pool that have stepped away from the market. It could be to enjoy the summer, it could be due to lower selections of properties, it could be due to financial or market confidence. If properties aren't selling or are receiving fewer offers on their offer date, the buying pool has shrunk, sometimes by a lot. And don't get me wrong, this is completely normal, and all realtors expect the buying pool to shrink and grow throughout the year. It happens every spring, summer, fall, and Christmas season. But a couple events have occurred over the past 30 or 40 days or so that have both sellers and realtors alike wondering if a slowdown this June and into the summer is in fact normal seasonality, or if there's something bigger going on in the market. The first one is the latest interest rate hike. On June 7th, the Bank of Canada hiked interest rates 25 basis points to 4.75%, informing consumers across the country that they will not yield to inflation and they're not screwing around. This was mainly in response to the fact that inflation rates rose by 0.1% between March and April, whose numbers were reported in May. Usually, when there is a rise in central bank interest rates, bank mortgage rates will follow suit and either raise mortgage rates aggressively or moderately, depending on how hawkish they're feeling about the economy. Realistically, a 0.25% rise in rates won't significantly affect a buyer's budget. For a household income of $100,000, an additional 0.25% is a difference of $6,500 of purchasing power. Yet still, a small hike can trigger a change in sentiment of consumers who are going to buy, who will then decide that either now is as good as time as any, or now is too risky. And if there are buyers who are already about to check out of the market because, woohoo, it's summer, this event can push them over the edge. I'll be honest, I was not expecting this hike personally. I follow Benjamin Tal, who is the chief economist at CIBC, and in an end of May presentation he did for the Ontario Real Estate Association, he basically broke down the numbers, showing that while the target inflation rate is 2%, if we extract housing costs, something that raising interest rates won't lower, we're actually already very close to 2%. And in fact, raising rates further will immediately lead to higher housing costs for the population of homeowners that are on a variable rate mortgage. Here's a graph that shows this pretty clearly. All this to say that at the end of the day, no one really knows what the Bank of Canada will do, not even the chief economists. My second talking point that I want to make here is about immigration. It's what's continuing to drive the high cost of housing and inflation. This country was built on the backs of immigrants, and the hole we're in with the Canadian economy will apparently be dug out with the cash that the new immigrants bring in. Canada is continuing to bring in new immigrants both directly and indirectly into the country. Indirectly through the student visa processes, where the number of student visas granted has increased by 75% or 1.75x since 2019, as you can see on this graph. If we look at this other graph showing the population change for the top 10 central cities in North America dating back to July 2022, there are 5 Canadian cities ranked at the top. One of the problems here is there is an obvious correlation between gross domestic product, which is basically how much money is turning in the economy, and population growth, which is directly supplied through immigration. There doesn't seem to be coordination between Canadian immigration policy and the central bank's need to bring down inflation. Canada has opened the taps to immigrants to enter the country, yet these new immigrant Canadians have the highest need to spend money on furniture, pots and pans, food, and of course housing, further driving demand and growth in GDP, which indirectly causes inflation, and the solution here seems to be to raise interest rates. This of course is immediately affecting current Canadians, but the next thing to really watch is unemployment rates, which historically have risen sharply after a sustained period of high rates. If high unemployment occurs, a recession is very likely to occur, followed by a rapid drop in inflation rates. Or maybe high unemployment, no recession because immigrant money, sustained high interest rates. Either way, someone's going to get effed, either new immigrants or lower income Canadians. How will this all play out? Who knows? Truthfully, our economy is being driven by money coming in from overseas, which is keeping demand high, which is keeping everyone employed. We're draining these immigrants of every dollar they have to pay for the hole we're in and giving them low chances to actually succeed long term in our country. Further, over-leveraged and lower income Canadians are certainly being stressed, and whose back breaks first, we'll have to see. I don't know what this will mean for our economy, or for our competitive positioning as a desirable place to live, or for current Canadians long term. My third talking point is the residential move to clear a path for fourplex new builds and conversions. Last month, Toronto City Council almost unanimously voted to allow for a change in the bylaws of any residentially zoned property in the city to allow for a conversion of up to 4 units without needing for a minor variance or to be rezoned. Previously, you had to be in an area zoned for multi-residential to allow for this to happen, but now you should be able to convert, say, a mansion in the bridle path to a fourplex if you so would want. This will of course have an impact on freehold land values, most significantly with detached homes, as you can more easily rebuild on that land. I believe this has already started happening, as this past April, we've seen the lowest number of detached homes for sale of any April in the past. Why sell your detached home when the land potential is so huge? This land in the city is probably the best thing you can pass off to your kids. So with all that said, let's jump into the numbers. So sales activity was up year over year by nearly 25%, even though new listings were down nearly 19%. Listing days and property days on market trended higher, likely because the buyer pool that could in fact purchase at these costs and high mortgage servicing costs has shrunk. Average sale prices are nearing 1.2 million, only down 1.2% from where they were a year ago. The average price of a detached home in the 416 is 1.9 million, flat year over year, while in the 905 it's gone up about 1% to 1,444,000. The number of detached sales has increased about 22% in both the 905 and 416 areas. Semi-detached prices are down about 2% in the 416 with an average price of 1.4 million, while being up about 3.9% with an average price of 1,083,000. However, transactions were down 8.9% year over year in the 416 for semi-detached, likely due to fewer listings available. For those not in the know, a semi-detached house from the 50s to 60s era of most of the outer boroughs of Toronto of Etobicoke, Scarborough, and North York will often be the same size in the interior as a detached house of the same area. So the spread in value between a semi and a detached is mostly in the potential of its land. When you buy a semi, it kind of is what it is. You can maybe extend it slightly, but a detached home can be rebuilt to be anything. In the last couple of years, I've seen this spread extend from about 7 to 10% between a semi and a detached in the same area of similar condition to today what it is about 15 to 20%. In contrast, semis in the 905 were built to be sort of a bridge in size from a detached home and are mostly smaller than detached homes, which to me explains the difference here a bit more clearly. Townhouses, which include condo townhouses, are up in the 416 about 1.8% in price year over year, with total transactions also up 15.8%. And they're up 24.3% in the 905, with average price up just under 3%. Townhouses, which seems to be the starter home of choice for younger families, are averaging about $1 million in both the 416 and 905. Condos, with transactions up year over year about 35% in the 416 and about 50% in the 905, are down 1.1% in value in the 416 and 6.3% in the 905. This is most likely due to the high cost of entry into the condo market. Fewer first-time home buyers have an ability to enter, and yet the number of investors looking to get rid of their high carrying costs due to higher interest rates, or condo owners looking to upsize, is pretty high. So with this property category, it really is likely an increase in supply and a decrease in demand. This is what the seasonality is looking like based off current reported numbers. I do expect a slower number, though not as slow as last year 2022. I feel like the market is a bit more prepared for a downturn and it's not wondering whether a collapse is imminent like what occurred in summer 2022. Instead, most sellers will just wait it out because very recent history says that prices will bounce back and restabilize. To give you an idea, this is sort of a rough line trend for how I expect the summer to play out, more in line of kind of what numbers were like in 2018. However, if you're looking for opportunity and aren't super picky about what you choose, I think June and July will be opportune times. As you can see, these are generally the slowest periods of the year and every year. And with the recent rate hike, a higher than typical number of buyers have likely stepped away from the market, making things less competitive. Lastly, this is a poll run last month by the Canadian Mortgage and Housing Corporation, and I just wanted to emphasize the sentiment towards Canadian real estate that everyone seems to have. The majority of homeowners are still very much pro real estate as being a good long-term financial investment, still trending above 80%. Of course, confidence is down from its peak in 2022, which is to be expected because people are stressed for sure. But that stress and uncertainty is almost solely being caused by financials if you look here the questions. So understandably, if you're in this camp as a potential mover or buyer, assess whether now is the time. But if you aren't concerned as much about your financials or your job security or your ability to service your mortgage and are waiting things out, do realize that there could be a cost to timing things, and the number of Canadians that have housing needs are still high, and many are just waiting until they are in a better financial position to execute on a move. So that's it for today. My name is Jonathan Lee, and I live and specialize in Etobicoke real estate, which is a borough of Toronto. If you like Toronto real estate content, hit subscribe, and I'll see you on the next one. Cheers.